Welcome to a new lecture in the RICS APC Essentials course. This course is crafted in order to help candidates to get chartered from the RICS under the quantity surveying route. In this lecture, we're going to be discussing accounting principles and procedures. It's a mandatory competency up to level 1, which is knowing. And the agenda of this lecture is going to be as follows. We're going to be starting with assets and liabilities. We're going to be shedding the light on insolvency. We're going to be discussing the difference between different financial statements. We're going to also be expanding further on accounts. We're going to shed some light on the most important ratios that are used within accounting principles and how to use these ratios for analysis. And last but not the least, we're going to be shedding some light on further considerations that any quantity surveyor should know regarding accounting principles. So starting with the assets and liabilities. The first one is the liabilities. The liabilities are what the business owe, or basically the debts that the business could incur. So there are two main types of these debts or these liabilities: short-term liabilities and long-term liabilities. The short-term liabilities could be payments for cars or vehicles in general if they are leased in the firm, as well as short-term debts, not forgetting to mention the consumables required for everyday activities in addition to the energy payments. The long-term liabilities are basically long-term debts, which could be payments for the mortgage, for buildings that the business aspire to own. And then we have the assets. It's actually things the business own. And this could extend to a wide variety of them things, like cars if the business own cars, buildings, in addition to cash, which is the most liquid asset. And the difference between assets and liabilities gives us the shareholders' equity or the net worth of the firm. And now let's start with some financial statements. First one is the balance sheet. The balance sheet is quite vital because it captures the financial stance of a firm at a specific point in time. It gives a better understanding about the levels of assets, liabilities, and the difference between the two gives the shareholders equity. The profit and loss account, it covers a specific period, probably a year. It lists all the income to the firm as well as the different expenditure. And this allows to understand how profitable or non-profitable the business really is. In the quantity surveying realm and cost management realm, we always do the cash flow forecast. The cash flow forecast is really useful to understand the levels of financial commitments that we're going to have over the next month or number of months. A cash flow forecast also gives a very good indication about potential financial problems. In contract terms, it might be some sort of early warnings. There are two main types of cash flow forecasts. The one which is done for the organization as a whole, and the one which is done for an individual project. The cash flow in itself, it allows us to understand better the money that comes in and the money that goes out. And we can have a much more detail about the money that comes in and the money that comes out so that we can analyze better where the money is going. And here are some examples. So the first example is the balance sheet, which is on the left. You would find the current assets in terms of the cash and inventory and the long-term assets such as the FF&E or furnishing, fittings and equipment. And you would see the total amount of assets. And at the bottom of this balance sheet, you would find the breakdown of the liabilities, the current and the long-term liabilities. And you would find that the overall liabilities are about £125,000. And when you deduct the liabilities from the assets, it's going to give you the owner's equity or the shareholder's equity, which is in this case $150,000. And as you can see up top, the balance sheet, it covers a snapshot in time, which is the 1st of January in this exact example. And on the right, you'll see the profit and loss account, which captures a whole duration. In this exact example, it's the year ending on the 30th of June 2011. The first half up top contains the revenue, which is $250,000 from the sales. There are some deductions from that revenue, taking into account the costs of goods sold, which is 90 grand. And this gives us the gross profit before deducting the taxation, the debts, the marketing costs, the advertisements costs, the energy costs, and so on and so forth. And when you deduct all of that, that's going to give you the final net profit. And in this case, it's 60,000. So the revenue was 250,000. The costs of goods sold is 90,000. That gave us a gross profit of $160,000. And then deducting from that various expenses, that gave us a net profit of $60,000. And this is all for this video, which is meant to be an extended trailer or a teaser. And if you want to have full access to the full length, the recorded videos, the notes, the presentations, and the question answer banks, do not hesitate to get enrolled on the APC Essentials course on the APC Mastery Path web portal, and you can make the best use of a coupon code which is APC35 for a 35% discount. All the best in your APC journey. Thanks a lot for watching, and catch you in the next video.